Unit 2, The Economy, Lecture 2, Economic Objectives and Indicators, Part A. In judging the performance of an economy, certain yardsticks referred to as economic objectives are used. Some economic objectives that are highlighted below are an acceptably high rate of non-inflationary economic growth, a high and steady level of employment of the labor force, quite a large percentage of the population actively employed, a stable general price level, the avoidance of undue inflation and deflation, inflation being an increase in prices and deflation obviously being a decrease in prices, a favorable and stable balance of payments, and the equitable distribution of income throughout the population. Now, in most market-based economies or free market economies, democratically elected government would prefer the levels and patterns of aggregate demand and supply to be determined by market forces. So they would like as little, if no government interference at all. However, it is recognized that market forces alone cannot ensure that an economy will achieve the economic objectives, and so state intervention to some degree in all countries does occur. And the ways in which government will intervene are exerted through what is referred to as economic policy. Now, economic policy can take one of three forms. It can take the form of fiscal policy, and this is where the government is directly involved. It can be in the form of monetary policy, and this is where the Reserve Bank is involved. Or it could occur through direct controls. So fiscal policy involves the use of government spending and taxation policies to influence the overall level of economic activity. Government spending occurs through the provision of goods and services and investments in infrastructure projects, and taxation is the tax generated by the government levied on companies and individuals. Now, in order to stimulate economic growth or economic activity or aggregate demand, the government can either increase its government expenditure or it can reduce taxation. Both these policies will inject additional income into the economy and have a positive impact on aggregate demand. If, on the other hand, fiscal policy is tightened, that means that taxes are increased or government expenditure is decreased, this will have a negative impact on economic activity and aggregate demand. Now, taxation and government spending, which are the tools of fiscal policy, are linked in the government's overall fiscal or budget position. Now, a budget position is essentially whether the government there's a budget surplus or a budget deficit. A budget surplus exists when the income the government receives in the form of taxation exceeds its expenditure on the payment for goods and services and debt interest. Obviously, a budget deficit arises when the public sector expenditure exceeds its income or receipts. Now, the budget deficit has to be financed, and it can be financed through the printing of money, but it is primarily financed through borrowing. Expansionary fiscal policy is usually associated with a budget deficit, and contractionary fiscal policy is usually associated with a budget surplus. Monetary policy regulates economic activity by influencing monetary variables such as the rate of interest and the money supply. The influence of the rate of interest is achieved by lowering or increasing the rate of interest and thereby encouraging or discouraging borrowing and consumption. Obviously, lower interest rates encourage consumption and delay savings, and higher interest rates does the opposite. Now, the money supply is the supply of money in an economy. If that supply is increased, interest rates, which is the cost of money, will tend to fall. And obviously, the opposite is true for interest rates if the money supply is decreased.